So thank you guys all for coming. This is a really, really big event for me. I really love teaching about compound interest, about financial security. And as you see right here, it says financial planning reinvented. So I'm going to be talking about that because it's very, very important, because the rules of the game, the rules of money have changed. They have evolved, but yet the traditional financial sector has not evolved with it. And so a lot of things I'm going to go over today are probably going to sound really strange. Or you're not going to understand it, or you've never heard it before, or you're going to wonder why nobody's ever told you this stuff before. Fact check it, go back, look at it, because my history and my story is really, really interesting, and I love talking about it, and I love the opportunity of being here. This is such a great event, and to start off with the Iron Man cowboy guy and then some of the other things, man, there is so much information here, there's so much positivity here, so much growth opportunity here, so I just want to be part of that. And anything I can do to answer any questions after that, I'll take a few questions. But we're going to get started. On who am I? Curtis Ray, married with 5 kids out of Gilbert, Arizona, owner of SunCor Financial. I'm the inventor of a product or a strategy called MPI, Maximum Premium Indexing. And that is one of a kind. And when I get through it, you guys are going to kind of scratch your head like, wow, this is pretty cool. I've been able to sell about 1,300 books in the last 3 months. It's Amazon #1 seller. And people are really, really raving over it because it's like nothing they've ever read before. It's like nothing anybody's ever seen before. Oops, I went the wrong way. Business owner, I have 4 different businesses. They're all profit generating. We have revenues in the last 15 years of over $75 million. I'm the developer of keep and grow money theory. Everyone always tells you how to make money. If you go from all the different seminars you go to, everything is about make money. Your financial security is based on making more money. False. It is about keeping money and growing money. The moment you understand the difference between making money and keeping money, your life is changed forever and everything will change. Because if you only focus on making money, there is a 99% chance that you will be retired on less than $50,000 a year. 99% of people retire on less than $50,000 a year because everyone focuses in the wrong place. Growth, make money, go for home runs, keep getting more and more home runs, but guess what happens when you go for home runs? You strike out, and you strike out a lot. But what if the concept was just go for singles? Just go for singles over and over and over and win every single aspect of the game, then something really special happens. And that's what I get to do. Is this book right here, Everyone Ends Up Poor, is like no book ever written because I call out everyone. I had no horse in the game. For 4 years, I researched this, and I wrote this stupid little thesis called The Science of Retirement. And I basically broke down the 401k, the IRA, the Roth IRA, whole life, VULs, IULs, real estate, and cash. And I put them side by side. And I said, what if I would have put money in this in 1990, what would it look like in 2015? To the penny. Trying to use leverage features here and doing this and kind of just going off to the statistics of the market. And there was this dirty little secret. They all underperform. Every last one of them. Because they're not designed to produce retirement income. They're designed to produce equity or account value or different things that don't equate to income. Income is king. And unless you're focused on income, it will not produce income. And so I'm looking at it, I'm like, why doesn't it produce income? And there was one glaring thing that always stood out, and it was risk, down market risk, and how catastrophic down market risk is. I'm going to get into that a little bit more later, but once you understand the difference between down markets and security, you'll never want to go near down markets again ever. This book talks about limits, restrictions, traditional planning. It talks about excessive risk, penalties, fees, taxes, a 4% rule. If anyone knows anything about an IRA or 401k, they're bound by this little rule called the 4% rule. You should only withdraw 4% of your account value in retirement or poor. You have $1 million in your account, only produces you $40,000 of income. A lot of people don't realize that. If you had $1 million in your 401k and you go to retire, you're only supposed to pull out $40,000 a year and then get taxed on it. So you're living on $35,000 even though you have $1 million. And no one knows that until they get to retirement because they hide it. Financial world doesn't want you to know that because then you'll be pissed off. Like, what the heck? I have $1 million in my account and I'm getting 35 grand or poor. And that's what I'm telling my book is everyone ends up poor. Here's another big thing. 95% of small businesses do not last more than 20 years. So if your business is your financial plan, like so many people tell me that, oh, my business is my financial plan. That's my financial plan. Ask Blockbuster how that worked out for them. Toys R Us, Sears, BlackBerry, Kodak. I mean, these companies that had 90% market share and they didn't end up right because they always reinvested back into the business. This book talks about compound interest. The greatest discovery ever. Albert Einstein said it's the greatest discovery man's ever come up with. The greatest invention ever. And so it talks heavily on why compound interest is your key to financial security and nothing else. It is the greatest key to financial security the moment you understand it. And then MPI. Everyone goes, what's MPI? It's the first secure leverage system available. And typically security and leverage are polar opposites. They cannot coexist. They can in one area and only one area. And we're going to get into that a little bit. The guy went over a little bit, so I got to rush. And so I'm going to put a lot of information on you guys. This is 4 years of research and development. I wasn't a financial advisor. I was just researching on my own time because I really cared about my family and my future. And so I'm going to give you all this information in about 30 minutes. And there's going to be some questions. Feel free to reach out to me. Everyone who's in this room right now is going to get a book also. I'm going to give you one of these books. Would you guys like the book now or pass it out at the end? Because if you want to see it and hold it and stuff, Porter, if you want to start passing them out, that's fine too.
Curtis, you're fine. There's nobody after us.
Oh, there isn't? Okay, cool. We'll go as long as you guys want to hear me. Here's the big problem. Most systems, like I said, are focused on making money, not keeping money. We need to focus on keeping money and growing that money securely. And then it's available on paperback, Kindle, and Audible. So what is MPI? And I don't want to scare you guys right now because MPI, maximum premium indexing, is an exclusively designed life insurance plan. And when I say exclusively designed, it's not whole life, it's not your VULs, it's all the things that you hear bad things about. It was exclusively designed for one reason and one reason only. Cash accumulation, the most amount of income. It produces the most amount of income. It is called a max-funded option B MPI. That is exclusively designed for the wealthy. The wealthy use max-funded option B, the MPI system, because of these 5 reasons right here, guys. And I can email this presentation to you guys. If anyone wants to reach out and get this presentation, it's available to you guys. Why a max-funded option B MPI life insurance plan? And this is going to sound really weird. I don't care about the life insurance piece. It is a means to the end. When you understand what's available inside life insurance is secondary. We don't even care about it. And this is why. One, they have tax advantages. How many people in this room have heard of the tax code 7702A? Anyone? This tax code is the only tax code left in the tax code that is 100% exempt from capital gains tax and estate tax. There is 0 taxes on your growth forever. And it's also tax exempt from income tax when you're pulling money in retirement. It is at the absolute lowest expenses possible. Remember when I said we're not doing it for the life insurance? So what we do is we buy the absolute lowest amount of life insurance required by the IRS code to get the advantages we want. That's how we keep the cost as low as possible. Traditional insurance agents and financial advisors, when they're using insurance products, they come in and say, we're going to get you the most amount of insurance. They make money on how much insurance they sell you. And so they're always going to try to sell you the absolute most amount of insurance required or available. Whatever you're willing to buy, that's what they're going to sell because that's how they get paid. But what if we flip the script? No, we're only going to buy the least amount of insurance required by the IRS code so that we get this guy right here. 100% tax exempt from capital gains tax and estate tax. How many people care about estate tax? You got to have $11 million or more to even qualify for that, so not very many people care about that. But how many in this room care about capital gains tax? Everyone should. How many people in the room care about income tax? Hopefully everyone. So this is the only IRS code, and go read about it. It's really cool. Few people know about it. 7702A tax exempt code. This plan also compounds at about 7.5% interest on average. Like I said, singles and doubles. We're not going for home runs. We don't need the 15, 20 rates of return. It is 7.5% on average, and we're cool with that. And I'm going to explain why we're cool with that. Most financial advisors, insurance agents, all these people are like, no, you got to go for home runs. You got to get those big years. Those are the years that protect us from the down years. If you don't get the 30, how are you going to survive the negative 25 year or the negative 30 year? Because we just want to go for singles and doubles and never strike out. Because inside the MPI plan, there is protection on your money. There is no risk to your principal value. 100% contractual guarantee you'll never lose a dollar in a down market. But how you do that is with the vision of singles and doubles wins the game. You get security as your cornerstone, and if security is your cornerstone, and you're getting 7.5 instead of 10, 12, 14, 15 like people are going after, you can maintain that. You can maintain 7.5 with no down market risk if you understand the rules of the game. And then the fun happens, secure leverage. If you have no risk to your principal value and you have the ability to leverage, guess what happens? You can leverage without the risk of leverage. In real estate, 2008, why it all blew up, if anyone was around at that point in time, what happened? You pull out a line of credit on a house. Then you bought a second house. You pull a line of credit on that house. You bought a third house. You pull a line of credit on that house. And all of a sudden, you have 4, 5, 6, 7 houses that all are leveraged. And when the equities in the houses drop 50%, your loan-to-value ratio is messed up. The bank's coming knocking. You have to still pay the interest. You're never going to make it back up over the next 8 to 10 years because that negative equity was too much to overcome. But what if you never had risk to equity? Well, what happened in 2008 if all your equities were maintained? Nothing. You had to pay some interest for a year like you already agreed to do, and then when 2009 started popping back up, you're exactly where you were before you started. And that's how secure leverage changes the game and why MPI will change the game. By doing these things right here, it produces up to 400%, 4 times more retirement income than any investment you put into. And that's been checked by actuaries after actuary after actuary saying, this is too simple, Curtis. It's too simple. Security first, who would have thought of that? Secure your assets first and then go play the game. Then go get your singles and doubles. So I want to talk a little bit about this tax code because it seems like when I talk to real estate agents or real estate, empires and stuff, this is the one they really love. They go, wait, no capital gains tax? Wait, what'd you say? How did we do that? I just became 20% richer, because you got that capital gains tax. And it is only found inside of a life insurance policy. It is the last frontier. There used to be multiple tax-exempt plans in the IRS, different codes. This is the last one. And people have tried to do it. People have tried to get around it, but guess what? You're going to tax a death benefit of a widow? That's not going to happen. And so it's the lone survivor. And everyone who sees it takes advantage of it. It's mostly billionaires, multimillionaires, politicians, professional athletes, things like that, people like that who use the tax code 7702A. But when I saw it, I'm like, okay, it's estate tax proof, great. Capital gains is tax proof, great. Income tax proof, well, everyone should know about this. It shouldn't be exclusive for the uber rich. Everyone should take advantage of this. And how we do it, how we get it so it's the absolute lowest cost is, like I said, this tax code tells you this little thing called MEC, Modified Endowment Contract. That limit, it's an IRS calculation. I'm a total math nerd, so all I care about is the calculations. This MEC limit says if you buy this much insurance, you can invest this much money and it's 100% tax exempt for life. Once it's in, you have no problems. So guess what? I'm like, well, I have life insurance already. I don't need more life insurance. So what am I going to do? I'm going to buy the absolute lowest amount of life insurance required by the code. I go to agents all the time and I go, hey, you guys should sell max funded option B because it makes your client way more money. And guess what they tell me? I don't make enough money off of it. Why would I do that? I only get paid on how much life insurance I provide to my clients. Why would I sell them the absolute lowest amount of life insurance required by law? Because it's ethical? I don't know. Because we're financial planners? Our job is to produce the absolute best retirement for our clients. And we still get paid well. Maybe instead of getting paid $10,000 on signing a policy with someone, you get paid $1,400. Sell a lot of them, exactly. And sell them in volume because you're actually offering a better product to your clients and you're offering all these features. By doing that, the costs are 1/3 of a traditional plan. When you hear the Dave Ramseys and the different people saying, watch out for life insurance, they're too expensive. He's right. They are freaking expensive unless you design it one way, max funded option B. then it is 1/3 the cost of every other life insurance plan out there. And by doing that, now you have 2/3 more money going into your compounding account, 2/3 more growth on that money from expenses, and all of a sudden it starts producing really, really crazy results. And the last thing that life insurance does for you, it's got a lot of legal protections from lawsuits. It is very favorable. It is very difficult to sue a life insurance policy until it pays out. So it gives you a lot of ways to protect your money. Like I said, it's not about making money. It's about keeping money and protecting money and growing money. So I'm going to talk about how we make it happen. Because we're in a world right now of instant gratification. We all want our home runs. Everyone, man, I talk to people all the time, even people at this conference, and they want the home run. Well, Curtis, your product doesn't give us home run potential. This is a financial plan. Financial plan is based in security. Your life has to be based in security if you want your future to look positive. Like I said, your business is not your financial plan. Everything eventually collapses unless you build it in security first. So the only way to make sure that you are taken care of, and the easiest way, the least amount of stress, the least amount of headache, the least amount of management, is a little theory from the book called The Richest Man in Babylon. Pay yourself first. It is before everything. It is the number one most important decision you can make in your life right now in this exact moment, is every time you make a profit on anything you do, whether you have a full-time job, whether you're doing real estate or this and that, is you take a percent of that money and you set it aside for your future. The only reason you should be in business and the only reason you should be in real estate and the only reason you should be investing is for one reason, making sure your future self is secure 10, 15, 20 years from now, depending on how old you are and how quick you got to make this happen. Everyone goes and reinvests back in their business. They make profits on one house, so what do? They buy 2 houses. And they probably make profits on 2 houses, and they buy 4 houses, and then the market collapses and they lose everything. And 10 years down the road, they did all this work and it equated to nothing. But if they would have bought 1 house and took 20% of that profit and put away for themselves in compound interest, and then did their real estate deals and all the other investments they have, guess what happens 10 years later? They have $400,000, $500,000 in this account. Compounding. Now they're secure. That's what it's about. Pay yourself first at least 10%. Invest in compound interest. Compound interest is the most powerful force in the whole universe. You will make more money in compound interest than you make in any other investment possible. And I'm going to show you why. I'm going to show you the theory of compound interest because a lot of people don't fully understand it. Like I said, we're in business to protect our future self. Business cannot be trusted when there's risk associated with it. Pay yourself first is the easiest way to financial freedom. It's the easiest way because it's already pre-designed. It already works itself. The good thing about compound interest is it requires no work from you. 0 work. And so when I say compound interest, the greatest of all, like I said, it's money growing by itself without any additional work from you. It just does its thing. Pay yourself first, money works for you for life, and no additional effort on your part. It focuses on growth. Growth, growth, growth. We ever hear that saying, rich people don't use their own money for anything? It actually makes sense that by the time I get to the end of this, you're going to fully understand what that means. It means rich people, all they care about is putting their money in growth, things that are going to make them more money. Because compound interest will make more money than all that. Debt is secondary. When people are like, oh, I want to pay off my house first. Wait, what? You're going to pay off your house? Your mortgage is 4%. Heck, I want to extend that out to 100 years if I could. If my wife would let me, I'd refi to 100 years. Because that 4%, when I can gain 7.5%, that means I'm losing out at 3.5% arbitrage because I wanted to pay off a debt. Growth, your mind's got to go into growth. You know, when I meet with people and say, Curtis, I can't start a financial plan. I can't start getting compound interest because I have debt. And I'm like, that's equivalent of saying I can't go work out and drink water until I get skinny. Like, don't focus on the negative because what happens if you start working out and drinking water? What happens to your fat? It diminishes. It gets smaller by itself. So what if you start putting your money into growth and compound interest securely? What happens to your debt? You now have growth to pay off your debt, not your principal value, because your principal value has to be working for you. Remember, rich people don't use their own money for anything because they put all their money into growth. And then from growth and other leverage systems, they then do what they need to do. But their money is always capitalizing on the theory of compound interest and the theory of Rule of 72. Anyone here know what the Rule of 72 is? The Rule of 72 is whatever amount of compound interest you're getting Divide that by 72, and that's how many years it takes to double. So if you're getting 10% interest, it takes 7.2 years to double your money. If you're getting 9%, it's 8 years. If you're 8%, it's 9 years. And so that's how you determine how fast my money's going to double. 1 penny doubled 30 times. Has anybody heard this analogy? 1 penny compounded 30 times is how much money? $5.3 million. Never putting in more than 1 penny. You put in 1 penny and let time do its thing. Let compound interest do its thing. It's $5.3 million. And that's why Albert Einstein called it, it's the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Are you an earner or a payer? Every decision you make, are you earning or are you paying? Are you interest earned versus interest paid? Compound interest. I'm going to do a few things, and I hope I don't get reamed on this. Rentals versus compound interest. So I did a 30-year model. Let's see what it looks like over 30 years. The National Association of Realtors told me that a 3.7% appreciation rate on houses is the national average over the last 30 years, and 3% is the national average on increased rentals. So I said, what does a rental look like over 30 years? In the first year, you buy a house for $100,000. You have $100,000 and you buy a house with it. And now you're going to rent it out forever. Or you take $100,000 and put it in compound interest and then do nothing. Just let it sit. In the first year, you're going to get $12,000 income. Let's just say you rent it out for $1,000 a month, right? You get $12,000. Your house is worth $100,000. Your MPI account is worth $100,000 also because you put $100,000 into it. At the end of 5 years, you would have collected, with the increases in rentals, $63,000 total. Your house would now be worth $114,000, so you got about $180,000 in assets. And this is only worth $131,000. Oh, look, see, real estate's way better than compound interest. Wait for it. Year 10, $137,000. You've now collected $137,000 of income. Your house is now worth $135,000, so you got about $270,000. This is only worth $211,000. Okay, hey, we're still winning. Real estate is way better. Oh, now 15. They break even. $370,000. Year 20, $500,000, $655,000. Year 25, $650,000, $1.1 million. Year 30, $830,000, $2 million. Because compound interest is doubling on itself every 6 to 8 years. So your $100,000 went to $200,000, went to $400,000, went to $800,000, went to $1.6 million, went to $3.2 million, went to $6.4 million, went to 12-point-something million, because time is a factor here. Compound interest is your long game. Real estate should be your short game. You are in real estate to make deals and make money to fund your compound interest. And the moment you understand that, everything in your life changes. And this can obviously change really quickly if you start putting in more than $100,000. This is just $100,000 and never doing anything. And what's also funny about this number right here, 570, that 570 doesn't include all their carpet repairs, countertops, cabinets, defaults, evictions, all the other, problems we have with rentals. I had 5 of them, because they are expensive and they are a bear to manage. And so at the end of the day, this may be only $200,000 or $300,000 that you actually got from it after you actually had all the expenses of it. This, you know how much effort this took from you? Zero. Zero effort. There's a reason why Albert Einstein said compound interest is the greatest mathematical discovery of all time. He did not say pay off your house is the greatest discovery. He didn't say go do this is the greatest discovery. He said the simple compound interest is the single greatest discovery of all time. Now, you guys see how it's $2 million and about $800,000 in equity. If you take your home rental income plus your appreciation, you're about $830,000 versus $2 million. That's a little bit more than double, 2.5 times more. But what does it mean to income? What's more important, having net worth and equity or spendable income? Spendable income. That should be you can't spend equity. That's the big flaw to most real estate. Is most your money is trapped in equity. They're like, well, I can sell it. Well, that doesn't do any good. You'll spend that in a couple of years because it's not growing for you. You've always got to have growth and coming in. So let's look what the difference is in this exact scenario in spendable income. Because at the end of the day, like I said, income is king. Income is king. So in the first year, you got $12,000 in income, $1,000 a month, you made $12,000. At year 5, with the appreciation rates per year, in MPI, you got no money. You got to put compound interest and just let it grow. You get no money from it in the first year. At year 5, your rental is now $13,500 a year. Okay, it's appreciating. You're doing good. At year 10, it's $15,000. 15, it's $18,000, 21, 24, and ultimately in 30 years, your rental income should be about $29,000 a year at the 3% increase. So it's $2,400 a month, $2,500 a month. Compound interest, 0. Then 12, 21, 41, 79, 150, $285,000 of compound interest renewed every single year. And you have $2 million in your account. That doesn't touch principal value. That's just the power of compound interest. Why compound interest is the greatest invention the world has ever produced. Like, I'm a disciple of Einstein. Like, I think the theory of compound interest is what the world's missing. And it kind of frustrates me that in schools, elementary school, junior high, high school, college, anything, we don't talk about this. You would think that who we dub as one of the smartest human beings on the whole planet, who said the moment you understand compound interest, you'll do everything in your power to put as much money into it as humanly possible, wouldn't that be something we talk about more often? Except for it doesn't make the system very much money. When you truly understand how it works, if you get all the money and your money's growing for you, how much does the world get, the system get? Not very much. All these systems are all about, management fees and set you up fees and real estate transaction fees and all the things. Everyone's got to make a bunch of money. But what if the compound interest just went to you? We set it up for you. And so right here, this $285,000 is spendable cash. Or if you retired at 25 years, it will produce this much indefinitely. Or you retired at 20 years, it produces that much indefinitely. And all of that is 100% tax-free. There's no taxes to any of that. Yes?
Okay, so just to clarify, that annual income, that's not how much you start making from there while it's growing? That's like if you stop.
This is if you said, hey, I want to retire in 5 years from my MPI account, I could pull out $12,000 a year every single year for the rest of my life. But it keeps compounding. It gets bigger and bigger as you wait. In this scenario, this is just appreciating, and so by this time, so if you didn't take any money out of this time, that's how much you get, which if you add all this up every single year, you make up in 2 years, and it's all paid off, and everything at that point is growth.
How do you guarantee 7.5% return?
Well, you can't guarantee anything. There's no guarantees in the world, just like real estate don't guarantee anything, stocks don't guarantee anything, but I'm going to show you why it averages 7.5 securely. Securely and guaranteed are similar, but they're not the same. Because this compound interest is the greatest discovery man's ever come up with, the greatest invention ever. But she is super hot. But she has a very, very ugly, nasty, mean little sister. And that is called negative compound interest. Negative compound interest, negative equity, down markets is so terrible. And few people understand this. That if you lose 50% equity in a down market, how much equity does it take to build positive to break even? 100%. You lose 50, it takes 100. It has double the effect. So you're making all this money, the markets, I'm getting my home runs, everything's great, the market crashes. Look at what happened in the stock market. If you had $100,000 in 2000, and this is stock markets with negative compound interest, the effects of negative compound interest. It's going down, it's going up, it's going down, it's going up, it's going up, it's going down. Look at this. 2000, it didn't break even until 2013. 13 years of zero gain because of negative compound interest. Even though the financial advisor like, we averaged 6% in that time. Except for you didn't take into account the negative compound interest. And that's why down markets are so catastrophic. And why when you lose equity in a house, we have one more rental we're trying to get rid of. It has not broken even yet since 2007. We bought it at 221. It is worth 207 right now. 12 years later of rentals and changing carpets and painting and this and that. And it's like, so I told my wife, just sell. I don't even care. I'll take the loss. I just want it out of my life. Let's just do this thing. Just because If you understand the rules of the game and how money works, it becomes simple. They made it complicated on purpose. So you don't understand it. Pay us. It's not simple. It's very, very difficult. That's why you need an advisor. That's why you need a planner. That's why you need that stuff. So this thing right here is, how do we avoid this? The guy over there asked on how do you secure your money? How do you guarantee it? And there is one way to eliminate risk out of your portfolio. One way to eliminate risk out of your cash value. And that is a thing called the 0% floor. I call it the ultimate feature. In my book, chapter 11, I believe, the 0% floor, the ultimate feature, because it is the only thing available that bypasses this risk. That basically ships off the ugly little sister to Siberia and say, never be in our life again because we don't want you in our life. And like I said, it's pretty easy to make money. Anyone can make money, but it is very difficult to keep money because of the negative compound interest. So how do we eliminate it? We guarantee no hits to principal value. You cannot lose in principal value is the key to this. 0% floor, how you keep your money. No down markets, no stock market hits. But it's in a little thing called an option. 0% to 11.5. That is everything. Singles and doubles, that's all you get. You'll never have a plus 20 year, plus 30 year, plus 50 year. You'll never have a negative 30, negative 40, negative 50 year. It is just a simple little 0 to 11.5. And with that, most people say, well, Curtis, why would you do that? You only average 7.5%. Even if you go traditional S&P 500 index funds, you'll average 9 over time if you give enough time, and that is true, except for they're not taking consideration negative compound interest. And even worse, they're not taking consideration, how many people in this room have heard of the theory, the 4% rule? Anyone knows what that is? The 4% rule is however much money you have in a 401k or IRA when you go to retire, you should only withdraw 4% of it. If you withdraw any more than 4%, it will run out of money within 23 years. And a lot of us live longer than, we retire at 60, 65. We got to plan on living to 90 now. And so your money needs to last longer. If you pull out 4%, there's a 97% chance it'll last for at least 30 years. So that's the rule they came up with, 4%. Why the 4% rule is so bad is because when you're younger, in stocks and 401k and IRAs, you're aggressive. You're getting 9 to 10% rate of return on your money. And then when you hit about 50 years old, what does your advisor tell you to do? You take your portfolio from stocks and you convert it to bonds. And now you went from 9 to 10% rate of return to 3 to 4. You turned off your compound interest. The moment you needed it most, you needed that replenish income ability, they turn it off because they have too much risk built in. So when they say, Curtis, you're only getting 7.5 to 8% in your portfolio, that sucks, man. We can get 9 in an S&P index fund. Except for we get 7.5 to 8 in our 20s, our 30s, our 40s, and our 50s, and our 60s, and our 70s, and our 80s, and our 90s. So if we're getting 7.5 and you're only getting 3.5 in retirement, what's my income? 7.5. You can take out 7.5 every single year and you'll never touch principal value. They can only take out 3 to 4 without touching principal value. So by security first, making security the cornerstone of your system, you have now doubled your income on the exact same dollar. It didn't make you more money because you weren't going to make more money. By the time you get to 30 years, they're the same. But you've doubled your income on the exact same dollar because you never had to abide by the risk pyramid. You never had to allocate, take your funds and allocate them from stocks to bonds because you were in a secure system that had the 0% floor to begin with. That's why this 0% floor is the income focused. You have to focus on income. Aggressive rates of return even in retirement, bypass the risk pyramid, the number one income feature because you maintain good compound interest even in retirement. Security of MPI is first cornerstone. Without security, you can never, ever, ever, ever have good income. It's impossible. It's mathematically impossible. But we eliminate the effects of negative compound interest. And now the fun part. So anybody who's asleep, wake up now. Because this is what you guys all came for. How you do secure leverage. Because everything I just told you, anyone could have told you. But now I'm going to tell you what MPI is. What's in patent pending right now? What is the thing? The company, mega billion-dollar business saw this and said, that's impossible. It's too easy. It's too simple. Like, how do we not think of this? Like, I don't know. Took the dumb I have a granite countertop business, so I say, took the dumb granite guy to figure it out because I had no restrictions. I had no limits on my brain. No one ever told me. I had no one talking to my ears. I said, hey, this is how I want to use your product. Well, we've never thought of it that way. Exactly. But this is how we do it. Secure leverage. As you guys know, leverage is the key to real wealth. If you know how to leverage, that is how it really works. Increases your assets up to 400%. If you can leverage correctly. The wealthiest people in the world know that leverage is success. Real estate has mastered leverage. So what I did originally is I took all the different products, 401k, Roth IRA, insurance products, real estate, and cash. I said, what do they all do well? Real estate dominates in leverage. They struggle in income production, but they dominate in leverage. So that makes up for their downfall. Cash is secure. It's got a 0% floor guarantee. Cash doesn't lose. It's got, away from inflation, cash has a 0% floor. What does insurance products do well? 100% tax exempt. Okay, I like that. What does a Roth IRA do well? It's post-tax money. So government can't touch it. They can't tax you on your income after that. And what do 401ks do well? Aggressive rates of return in the stock market. Well, let's take all the well and put it into one. And this is how we do it. It's really cool. So if you could leverage without traditional risk of leverage, and this might complicate somebody, OPM, other people's money. And it is so simple. You guys should all know the line of credit. You have a house with equity in it, right? What do you do with that equity traditionally when you want to leverage it? You get a line of credit on it. You go to the bank and say, hey, I would like a line of credit. What do they say? What's your collateral? You go, I got 100 grand in equity over in this house. They're okay. What do? They put a lien on the house. They don't touch the house. All they do is put hey, for our security reasons, we put a lien on the house. Then what do? They give you money, real money. What do you do with that money at that point in time? Traditionally, you go buy a second house, or you remodel your house, or you do a million other things. But the problem with that is that money you borrowed is now insecure. The market could dip tomorrow. And now you still owe that loan, you spent the money, and you lost your equity that was backing that money. It's a triple whammy that 2008, the world had never seen before, when over leverage occurred, and then when the markets dropped 50%, we can't rebound from that. But what if you had no risk to your equity? What if you had no risk to your principal value? This is how we do it. Grow money, cash value is used as collateral. So what if you had 100 grand inside your financial plan? This financial plan has a 0% floor guarantee. I go to the bank and I say, hey, bank, I want to get a line of credit, just like I would have with real estate. They go, okay, what's your collateral? I got 100 grand over there. They go, no problem at all. What did they do? They put a lien on it. They didn't touch it. This money is still gaining me 7.5% to 8%. All it has is a lien on it. I now have zero liquidity, but it's still there gaining me my compound interest. They give me $100,000. What do I do with that money? What should I do with that money? Make money. Reinvest it somewhere. Where should I reinvest it? Or where should I invest it? Where's the only place that we can invest it that has security on principal value and gaining more than 4%? Back into the exact same plan. It's a 1-second transaction. I got money. I have 100 grand here. I use it as collateral. I get a new 100 grand. What do? I put it right back in. I now have $200,000 in an account. No different than if you had a house, you pull a line of credit, and you bought 2 houses. You now have double the asset appreciating for you simultaneously. I have 100 grand, I get a new 100 grand, I put it in, I have $200,000 now. All $200,000 is gaining 7.5% interest on average. So it's gaining me $15,000 of compound interest. But I'm paying $4,000 on it, 4% interest. So on the borrowed money, I'm gaining a 3.5% arbitrage spread. Stock market collapses the next day. 2008 happens the next day. What happens to my $200,000? Maintains. I do pay interest. We have to pay interest on down years. We get it. We signed up for the interest payment. But guess what happens when it kicks back up in 2009 and we get 11.5% interest gain? We got 11.5% on our money and 7.5% on their money. And over the history of the stock market, we have 100 years of stock market data that says you will average about 7.5% in this system. The loan rate's 4%. So in theory, you can gain a 3.5% arbitrage spread securely Because your principal value is always secure, and worst case scenario in a down market is you pay interest that year. We signed up for the interest. We get it. Some years our money, we have to pay interest on it. Comes out of the cash value. We don't pay it out of pocket. There's no out-of-pocket transaction. Your $200,000 would actually go to $196. They'll say, hey, you owe $4,000 for interest. Do you have it? I'll just take it out of cash value. Okay. We recontribute, as I put here, we recontribute 10,000 plus 10,000, you now have 20,000. New money's gained 3.5% arbitrage, no risk to leverage money, and the system is automated. Your only job is to pay yourself first. Your only job is to feed the beast. You pay money, everything else from that point on happens by itself. Compound interest happens, the leverage feature happens, you need to sign, hey, this is what we're doing with your money. Okay, cool, sign. And then arbitrage is achieved. When I went to an actuary, he told me that's impossible. You cannot produce arbitrage indefinitely because the market will get saturated, too many people will get in the game, and then you'll lose arbitrage. I said, that's not true. There's one way to do it. Inside security, inside the MPI system. He looked at it 2 months later, said, wow, this is going to change the world. The rules of money have now evolved. You can now have security and good compound interest. Like I said, singles and doubles. I never go for a home run. I don't want it. People like, Curtis, you should invest in Bitcoin. Why? So I can lose all my money or steal someone else's money? Because every up market requires a down market. Every down market means someone lost a ton and someone gained a ton. But why not everyone just win? And the richest man in Babylon, somebody asked that question. Well, can everyone win? No, there's no way everyone can win. Somebody has to be a winner. Someone has to be a loser. That's not true. There's always a winner, there's always a loser because of greed or because of stupidity or this guy invested terribly and this guy invested great. But if everyone just thought of singles and doubles securely, autopilot, just make it happen, take advantage of the greatest mathematical discovery of all time, the greatest invention man's ever come up with. If you take advantage of that and you make sure security is your cornerstone, it is now easy for everyone to win. So that is what MPI is, maximum premium indexing. It is long-term maximum income. This is your long play. This is not the short play. This is your long play. You will not be a billionaire tomorrow. Doesn't work that way. But you can have a whole lot of secured income in 10 years from now, or 15, or 20, or 25, depending on your age. And it will produce up to 4 times more income than any other thing you put your money into. If you care about spendable, tax-free, secure income, this is your long play because it will outperform a VUL, variable universal life, index universal life, whole life, 401k, IRA, and rentals from hey, Steve. So MPI is also security on your money. When people ask me, Curtis, this sounds too good to be true, I'm like, I get it. I lay in bed at night saying, this was too easy. It was too easy. I'm just a guy. I got a 36 on my ACTs in math, so I get it. I understand how numbers work. But I can't be the first person to ever question why everyone ends up poor. I cannot be the first person to say, why do 99% of people end up on low fixed income? Even ones who have rentals and this and that and that. They end up on low fixed income, and it's because it's not income focused. Tax-free income, capital gains, and inheritance tax-free. That's huge. That's one of the things MPI. High rates of return through leverage. So we start off at 7.5, but once you start including that leverage, it increases 2% per year every 5 years. So by 5 years, you're getting 9.5. By 10 years, you're getting 11.5, et cetera, et cetera. So by the time you get to 20, 25, 30, 35, 40 years down the road, you're at 20, 25% compound interest securely. There's nothing like that. Even to the point that I'm like, oh, that looks kind of scary. Like, I don't even want to say stuff like that, but it's math. It's objective. And how I stress it, I don't do averages. I took 1980 to 2015, and I plugged in real life rates of return through historical data, and said, if I would have started in 1980 or 1990 or 2000 or 2010, what would it exactly look like today to the penny? And every single time, at minimum, 400% increase on spendable retirement income. Life insurance security, like I said, there is a little bit of life insurance. Life insurance is good, but it's not your life insurance plan. Some people it may be because you're putting a lot of money in whatever they require you. But a normal person who comes to me, Curtis, I want to invest $10,000 a year. the Mecklem, it's like 300 grand of life insurance. They're married with 4 kids. It's like, hey, that's probably not enough. Let's get you a term policy also. Because this is not a life insurance play, but the life insurance piece is a cherry on top. That is just a bonus. But if we maintain that life insurance, everything is tax exempt from that time forward. Simplicity and low expenses. Who wants more simplicity in their life? Who would not love that? That is why I do what I do, because the math tells me that. Albert Einstein tells me that. Warren Buffett tells me that. Focus on compound interest and nothing else, and life is okay. Why even worry about all the other complexities of other investments? And don't put all your eggs in one basket unless it's secure. You can do that if it's secure. The why you diversify is because nothing is secure. You have to guess and check which ones are going to win for you that day. So you're like, okay, I'm going to put it everywhere and hope that 6 or 7 of them work, and the 3 that do not work, then, oh well, at least the 6 to 7 worked. But what if one of them just worked? And it was slow and steady and simple. And it's education-based. I really, really focus on education. When you guys read my book, if you can take the time to read the book or listen to it, you'll learn more about money in that book than any book you've ever read. And I'm obviously a little bit biased, but I've had multiple super actuaries, super smart financial guys, Steve Bond, the man himself, say, this is one of the most interesting things I've ever read in my whole life, because it's just simple. I'm just a guy who researched it for 4 years because I was bored and wanted to find out why. The real story is I lost a lot of money in 2014. And when I say a lot, I mean a lot. And at that moment, I said, I will never be vulnerable in money again. And I had a granite countertop company and an import-export business and a few other side businesses, and we were making a lot of money. And Armageddon happened to me on November 1st of 2014. And on that day, I said, it will never happen to me again. What did I do wrong? I did everything right. I treat my clients right. I go out and kick butt. I do everything right, and I still ended up poor. Why did Blockbuster go out of business? Why did Toys R Us go out of business? Why? All these people who do everything right, they still go out of business. Evolution happens. Rules of the game change. You've got to stay up current. And on that day, I said, I'm never going to let myself be in that situation again. And I took 4 years of my life to say, what would Albert Einstein do? What would Warren Buffett do? What would this do? Why does a 401k suck? Why does whole life I consider the worst product on the whole planet? Why? All these different things. Holy crap, there's a solution. There's a very, very simple solution. And when people say, Curtis, it sounds too good to be true, I kind of say this one thing. Mutual of Omaha. Anybody familiar with Mutual of Omaha? 110 years, A+ rated financial secured company. Fortune 500, privately owned, 6,000 employees, $6 billion in assets, based in Mutual of Omaha. When they saw my system, they told me I was full of crap. They said, this is impossible because it's too simple. 2 months after their actuaries tried to break it, 2 months, they called back and said, we would like to be partners with you on this. Let's take this nationwide. We'll be your backing. You go tell your story. And that's what I do. Every day, all day. I go Facebook Live, I go to keynote events, I go to podcasts, I do other live events and say, guys, man, the rules of the game have changed, man, and they're exciting. And they're built in security. It's not fluff. It's not Ponzi. It's not all the other things. I'm sure you all remember 2017 November when Bitcoin was doing its thing. And everyone's like, get into Bitcoin. It's the way of the future. And guess what I said? It doesn't satisfy the rules of money. And that is, pay yourself first, protect your money at all costs, and compound it.
You mentioned that one of the main reasons why this works right now is because there are tax laws that haven't been implemented. Now, if those tax laws were to change, if everybody jumped on this, how would this affect it?
Well, taxes are taxes, obviously. The thing is, it's like a Roth IRA. So your income will never be affected. But estate tax, who knows? All we know is 7702A has been around for hundreds of years, and it's never even been touched. It's been on ballots, but tax the death benefit to a widow? What kind of inhumane human being are you? And so the one funny thing that I like to always tell people is, you know who uses 7702A? Politicians. Politicians, billionaires. So what are the chances of that tax code going away? Almost nothing. It's never even been close to being on the ballot because rich people they design the system for their benefit. And this one plan was designed for them.
There was
7.5% return. There are people like Warren Buffett and Bogle and Dalio that have said the return on the stock market in the next 10 years is not going to be as good. But I've got a friend that's a financial planner, and he said that may be true, but the stock market is probably still going to be a good bet for most people. And I would suggest that this will still be the best bet for most people.
Of course, because in down markets, we look way better.
Yes.
If the stock market averaged 25% every single year, put your money in stocks. Because we're only getting 11.5. In down markets, is where we really shine. Why we shine so well from 2000 to 2018 is because we never took principal hits, ever. And so, real quick, let me answer that question. We don't guarantee 7.5, but we guarantee zero risk to your principal value. That is the thing you need, because the top side doesn't really matter. The stock market will average 7 to 7.5 over the next 20, 25 years. It has every 25-year segment for the history of the whole stock market. Some years are negative 50, some years are 12, some years are 13. It's designed to always increase like that. And so the upside's not quite as important. The 0% floor is the ultimate feature.
Yeah, I've been in the market 29 years, and I'm the one who said 100% loss. Why would you think I said that?
Because you felt it. You felt it.
I've lost 50% a year, and I've had to wait 5, 7 years.
No, 2000, you had to wait till 2013. It took 13 years to break even.
Yeah, I paid for my education.
Do you have to do like a health check?
There is a medical. And so, but like I said, the life insurance is a means to the end. So when I have a client who has cancer, guess what? Do you have a spouse? Do you have kids? You can still own a policy on someone else. The life insurance is just a means to the end so we can get all these advantages that we want. And so we will find someone insurable to make sure your money is protected, compounded, and leveraged. We'll go back there.
Is this the concept of like being your own bank? No.
Wait. 5 minutes? I was told no one's behind me, so I could go a little longer because I was 10 minutes delayed.
Closing session right next door in 15 minutes and then dinner right after. So sorry to interrupt.
Okay.
But that'll be starting here very shortly.
Okay, cool.
Thank you so much. You're doing awesome.
Thank you, Steve. So I actually, hopefully nobody has a bank on yourself in here, and oh crap, this is being recorded. Bank on yourself and be your own bank, unfortunately, is manipulative because it's based on a whole life product that is only getting you 3 to 4% interest, and you're still borrowing it at 5. So every time you borrow against be your own bank or bank on yourself, you are losing 1% on your money every single time. They don't tell you that. They manufacture arbitrage by saying, hey, put your money in this life insurance policy. You can leverage it out and pay off 10% interest over here. They don't tell you you're losing 1% on your money when you do that. And then, but once you pay off your interest, guess what? You're losing 1% forever on that loan until you pay it back. And so why this works where whole life doesn't work, because I wish I could have invented the name be your own bank. How cool, like it just sounds cool. Be your own bank. I just want to buy it because it sounds cool. It's unfortunately not designed to produce internal arbitrage. You have to manufacture arbitrage by paying off higher interest rates, where this is designed the other way. Internally, your internal rate of return is 7.5. So if you're borrowing at 4, it makes arbitrage by itself. You didn't have to go pay off debt. You're always reinvesting back into the system because internally it makes the arbitrage, not by manufacturing it.
Who's lending it for though?
Mutual of Omaha right now is. They have a cap, a guaranteed maximum cap of 6% for life. They've never crossed 5 in their history. And so, since 2000, when the IUL was designed. And so, I do all my spreadsheets at 5% because that's the highest been. But right now, current rates are 4%. When you saw they tried to raise their rates yesterday, the Fed came out and said, crap, we're stopping because markets adjust to that. So we're kind of all a slave into it. So when I talk to actuaries, they think that 4 to 5% is what it's going to be at least for the next 20, 30.
So we don't have to go get a HELOC on a house.
It's all automated. No credit check required, no asset check, no nothing. It's a 24-hour transfer because it's dollar for dollar loan. They don't need anything from you because you have assets that they just dollar for dollar.
But you gotta keep it in there a while before you can start drawing.
Of course, you need the compound effects. It's doubling every 6 to 8 years. So if at at 15 years, it would produce you $75,000 in income. That means at 21 years, it's producing you $150,000. At 27 years, it's producing you $300,000. It's growing that fast. And so, yeah, you want to wait and minimize it so compound interest can do its thing.
And maybe this is a lack of understanding or I missed something. What is the money being invested in to gain compound interest?
So Mutual of Omaha, they're actuaries. They're not financial advisors. They are risk mitigators, not risk takers. So they take your money and they invest it. They vet it into options that have security, in treasury bonds that have long-term security, and then other things that are really, really secure. Some people do railroads and cattle and things that have long history of secure, slow and steady, 8 to 10. We're not going for any 30s and 40s and 50s. We're just our job is to protect your money. We're an insurance company. We are risk mitigators, not risk takers. And our history tells us we're going to average about 9% rate of return on your investment. We're going to give you 8 of it. We get to keep the difference. That's how we make money managing your money. And so it's a partnership with one of the largest institutions on the planet saying, hey, we trust you. You've got actuaries who go off probabilities, not speculation. Our history tells us we're going to average this. And by doing that, we're going to guarantee you no losses, but we're going to cap you off at 11.5. So we're going to go here, and then I got to finish up. We'll go here, 3 more questions.
So the main difference between this and like an IUL is maybe 2 things. Like A, you have a lower cost of insurance because you're buying less insurance, and then the arbitrage that you're talking about?
Yes. It is a max funded option B, which cuts your cost 1/3, 2/3 cheaper. So right there, you've just gained a ton of money. And then the arbitrage features my development. That's what's in patent pending, the algorithm that tells you when, where, how, and with what money to maximize the use of your money.
Okay, let's say catastrophe strikes here, and you want to get out from Omaha, Mutual of Omaha, and you want to go to Zurich. They find the program, and they want to do that. You want to go to to Zurich. Can I do that?
Well, your money is your money. Unfortunately, you'll lose tax exempt. So any growth, you will be taxed on it. So you have to maintain that tax code for life so that you never get taxed on your growth. And so if you were to strip out and say you would put $100,000 and it's now worth $200,000, when you pulled out $100,000, you've already paid tax on it like a Roth IRA. That $100,000 is now capital gains. Like you got to pay tax on it because you canceled your 7702 option.
Okay.
So,
Borrow from it.
what was that?
But if you borrow from it,
Yeah, that's why you always borrow against it because you're gaining spread and you maintain your tax exempt. Green shirt?
Yeah. So you were saying that you had like the 0% on your principal. Is that only what you put in or also?
Nope. Every year it resets. So if you had $10,000 a year 1, gain 10%, you have $11,000 on day 366. They now set it $11,000. Your principal is now $11,000. So last thing, guys, to end, we have a sign-up sheet back there. Please leave your information, grab a book, read the book, reach out to us because this is life-changing. Who is MPI for? It is for anyone who cares about secure money and compound interest. We have 3 traditional plans. One is MPI traditional planning, 18 to 60 range, give or take. You got to worry about retirement. You got to get your money growing. Even if you're 60 right now, you still have 30 years till you're going to die. There's plenty of time to make a lot of money and make sure your system is secure. Kids policies, do not do a 529 plan. That is based in risk, that is based in stocks, that is based on the 4% rule, and eventually ends up doing nothing. What good is leaving college debt-free if you don't have any growth? But what if you're growing and doubling every year? You have 50 grand in a college fund, and then they go to college. By the time they leave college, it's 100 grand. So why would you pull out the 50 to pay for college when your compound interest would double that? And let's just say they maintain their 50 grand debt. Within 6, 7 more years, it's 200 grand. 6, 7 more years, it's 400 grand. 6, 7 more years, it's 800 grand while they just paid some interest, some simple interest off of it. And so kids' plans are really, really important. And then the legacy planning. People who have a lot of money and they want to leave it tax-free. How do we do this? We got to get that money into 7702A. You still own the money. We do a lot of really cool things to double your income immediately and make sure it's tax exempt for life. So that is my MPI system. It's been building for 5 years. I really hope that I can talk to each and every one of you. Porter back there is part of my team. He's also going to be following up with people. My wife's back there. She makes sure I don't do stupid things. And, and I really, really thank you guys for your time because this is really important. So, thank you.